I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, what JPMorgan just said, is outright shocking. And this comes at a time when optimism for the U.S. economy is building, and investors believe the U.S. stock market is going to lead the broad economy higher. Yet when you hear what Jamie Dimon just said, it's going to put all of that into question. Plus, we have a sponsor for today's show. This biotech company is creating affordable diagnostic and digital tools, and I'm going to show you why we think the opportunity for their stock is now and how you can trade it for a potential 40% gain and what I think will need to happen for it to potentially even double in value. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, if you're wondering what we're doing on Main Street, well, we're trying to get the pulse from small business owners of to why they're suddenly so discouraged. Let's head over to the National Federation of Independent Businesses, where we start our show today with the headline, Prices rising slightly on Main Street as inflation remains a top business problem. Now, I find this interesting that small business owners think inflation is a problem because they need inflation to drive prices higher to keep their margins up. Because normally when we see high inflation, it means that demand is strong. But one of the challenges we're seeing right now is that inventory levels remain at rather high levels. And yet we continue to hear they're not high enough. It only makes us wonder, is this a case where small business owners believe if they stock up, people will buy? But one of the problems is we're starting to see the trend move in the opposite direction. And here we have from today's Small Business Optimism Index, it dropped 0.6 of a point in August to 93.1, the 20th consecutive month below the 49-year average of 98. And that is a real key point here because what you're seeing is small business owners are hopeful, but they're not overly hopeful. They're actually a bit discouraged here. Of course, the question should be why? Well, they've had to give pay raises to their employees. They've had to absorb higher costs. They brought on excess inventory, and the one thing they need is consumers to come out and spend in a big way. And here we can see that 23% of small business owners reported that inflation was their single most important business problem, one that I'm not sure I agree with, but that's how they see the world. What small business owners' views about future sales growth and business conditions are discouraging. Look at this. Owners want to hire and make money now from strong consumer spending, which makes this real interesting because if they actually knew what Jamie Dimon just said, which we'll look at a bit later in the show, it's going to suggest that what these small businesses are hopeful for is a strong consumer is unlikely to happen, putting them under a lot of stress of how do you clear out all this inventory? Well, we know what it's going to lead to eventually, and that's fire sales and deflation. And here we can see one of the challenges. Now, I'm showing you retailer inventories on a year-over-year basis against the consumer price index. Now, one thing I want to note here is that retailer inventories are still near all-time highs. But nevertheless, what I want you to see, as demand goes down as shown in the consumer price index, retailers are still building their inventory. What they want to do right now is kind of like what happened during the global financial crisis, where they're trying to clear out their inventories as margins went higher and inflation rose. But this time, they're still building inventory as demand comes down, which suggests that as the CPI, which we'll see tomorrow, continues to likely fall, that eventually retailers are going to have to slash their prices in a big way, and that's going to hurt a lot of them at the margin. And yet a net negative 14% of all owners reported higher nominal sales. So this is non-inflation adjusted in the past 3 months, the lowest reading since August 2020. So that means they're struggling here as a net percentage of owners expecting higher real sales, that would be inflation adjusted volumes, declined 2 points to a net negative 14%. So you can get the picture that they're already starting to see sales growth slow here because even though nominal sales moves up, it's not inflation adjusted. So that's really important. Now we go on to hear that they're complaining about their inventory gains. They'd only declined 4 points to a net negative 7%. 11% reported increases in stocks and 16% reported reductions. Of course, 5% of owners viewed the current inventory stocks as too low, which baffles me entirely because the frequency of reports of positive profit trends was a net negative 25%. So they're already struggling at the margin here. And what I'm suggesting to you, for these small businesses, it's going to get even worse. And that's why when we look to these big banks and you think about the information that JPMorgan has on their customers, they've got the accounts of the businesses, they've got their customers, they've got the credit accounts, they know everything about spending patterns. And that's why when you see what Jamie Dimon said was rather shocking. Among owners reporting lower profits, 28% blamed weaker sales, so there's demand going down. 24% blamed the rise of cost of materials, 15% cited labor costs, 10% cited lower prices, and 5% cited the usual seasonal change. And here we can see that just how bad this National Federation of Independent Business, Small Business Optimism Index is historically. Is you're looking down here. This is kind of, the global financial crisis is down here, and we're just above kind of where these businesses felt coming out of the financial crisis. So here we are potentially now looking at going down further into what is crisis levels. In fact, business owners are so discouraged they're at the same level they were at the worst of the pandemic. And yet the mighty American consumer is about to hit a wall, this according to investors, and we talk about how this would be really bad news for small businesses. So I kind of want to go through the setup here. The small businesses, while they're discouraged, they're really hoping for a turnaround. And the reason they're hoping is because they're desperate for one. But the reality of the story is, as we've been making the case, consumers are in a bad place and about to get worse. More than half of the 526 respondents said that personal consumption, the most important driver of economic growth, will shrink in early 2024. I'm making the case we're going to see that by the end of this year, which would be the first quarterly decline since the onset of the pandemic. Another 21% said the reversal will happen even sooner in the last quarter of this year as high borrowing costs eat into household budgets while COVID-era savings run down. And notice, there was no mention of higher interest rates and what the effect is on credit card minimum payments. No mention here yet of the student loan repayments restarting in October. All of these things are going to be a further drag on the discretionary spending ability of the average consumer, particularly if next week we see the Fed raise rates again. The likelihood of a soft landing, falling inflation, and the end of Fed tightening at peak interest rates and a stable dollar, stable oil prices, all those things help drive the markets up. Now you start to see that the soft landing is really a myth. The Fed has really never engineered one. So is inflation going to come down? Yes, we know demand is going to fall here, but will the peak in interest rates? Well, we'll find out more next week on what the Fed's going to do. But notably, will the dollar stay stable? Unlikely. If we see a recession or financial crisis, look for the dollar to just go vertical here. And oil prices, well, as demand goes down, oil prices fall too. So what we're seeing here is a setup for the U.S. equity market may not be as positive as investors think. And here we can see if the market loses confidence in that scenario, well, the stocks are vulnerable, particularly as profits go down, which we're seeing and happening in the small business space. The big question, is this strength in consumption sustainable? Well, I don't think it is. It is not sustainable. This is according to Anna Wong, the Bloomberg Economics chief U.S. economist. She said because it's driven by these one-off factors, notably a summer splurge on blockbuster movies and concert tours. Well, again, the bigger issue here is that consumers are running out of their pandemic stimulus. Many already have, and the rest are coming very soon. As that money is gone, well, the next thing we know, there's going to be a hard adjustment down in spending, mainly because people have a lot more debt. The cost to service that debt is higher. And of course, some of that debt, as we know, they haven't been making the payment on. Starting in October, they will. Researchers at the Federal Reserve Bank of San Francisco say the excess savings that have helped consumers get through the price spike will run out in the current quarter, a sentiment that 3/4 of the respondents agreed with. I, of course, who didn't respond, are one of them. But here we can see that Jamie Dimon says it's a huge mistake to think the economy will boom with so many risks out there. So here you see, that's why I wanted to show you kind of where the small businesses were at. They were discouraged, but they're hopeful that the worst now is here. And what I want to suggest is perhaps the worst is yet to come, because as the last piece just said, the U.S. consumer is about to hit a wall. And I think Jamie Dimon has a really good idea. This is about to happen. Healthy consumer balance sheets and rising wages are supporting the economy for now, he notes. But keep in mind, we've made the case that as inflation continues to fall, total compensation growth continues to fall, because where do businesses get the ability to pass on higher wages? Well, they get it through inflation. As that comes down, the chances of them cutting themselves at the margin to pass on higher wages is highly unlikely. But there are risks ahead, Jamie Dimon says, who was speaking at a recent financial conference. Topping his concerns include central banks reining in liquidity programs via quantitative tightening, something we actually don't believe has any effect. But of course, we know that banks love QE, so in this case, he would love to see it stop. The Ukraine war and governments around the world spending like drunken sailors. Now that is a problem, because as you go into the next recession, what should happen in this kind of Keynesian kind of style of economics that we live in this world? What you want to see is during an expansion or a boom, which arguably we had coming out of the pandemic, what you should see is governments spending down their debt in an ideal situation. Now, I know some of you are laughing because we never see that happen, but that is exactly what's supposed to happen. Or at the very least, they should cut their deficit spending as low as possible. What have we seen? It's just the opposite. Governments are excited about all of this money that they borrowed and spent, and it came back in the tax revenue, and they just can't get enough. And the challenge here is going into the next recession, the next global recession even, is that all this government debt was going to have to be paid on by somebody, and that's not exactly going to be good for the consumers when the government's forced to raise taxes to deal with all of this debt. And to say the consumer is strong today, mean you're going to have a booming environment for years, is a huge mistake. And yet, what do we see? Investors are buying into the market thinking that there's this a big raging bull market coming. You hear small business owners still don't have enough inventory because they believe the U.S. consumer is making a rebound. And yet here you see from the CEO of one of the biggest banks in the world saying, look, I don't think this outcome that everyone believes is going to happen is true. And yet he says businesses feel pretty good because they look at their current results, which is true. But he said those things change, and we don't know what the full effect of all this is going to be in 12 or 18 months from now. And yet we actually do, because when we see those financial conditions tighten and banks tighten lending standards, that means less new money is created as consumers don't have access to credit. Don't have access to credit, you don't go out and spend as much. That affects these businesses. He knows what is coming, and that's what's interesting here. He's already telling you the next 12 to 18 months are going to be brutal. And while JPMorgan and other banks have been over-earning on lending for years because of historically low default rates, strains are emerging in parts of real estate and subprime auto lending. He said, of course, I'm going to show you, it's not just those sectors. If and when you have a recession, which you're eventually going to have, you'll have a real normal credit cycle. And a normal credit cycle, something always does worse than expected, he said. And that is absolutely 100% true. The challenge we have, and we've been making the case on the show, is we have a largely insolvent small and mid-sized regional banking system around the country right now, and we can't rely on them. So when we do see the credit crisis hit, we can already predict these banks between defaults, not just on the consumer side or the credit card side, but you have to factor this commercial real estate factor as well. Well, when all of that hits, there's going to be a whole lot of banks that just won't make it. And here you can see the delinquency rate on all loans is shown in red on a year-on-year rate of change, just starting to turn positive. And we're overlaying this against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And what do you see? As banks tighten lending standards and restrict credit, what happens is the delinquency rate starts to rise. Now, normally the banks tighten ahead of that, which is a bit unusual going into the global financial crisis here. But what this suggests is that consumers do not have the money to pay their bills to begin with, so the only reason they're able to stay afloat is getting more and more credit on the hopes that they get ahead of the 8 ball, and as banks tighten lending standards, start to slow the creation of money. Well, again, it's a game of musical chairs. You don't have enough chairs for all the people that need them. In this case, not enough money to pay on all the debt. When the music stops, well, those defaults are going to surge higher. And yet fears over access to credit hit the highest level in more than a decade, which makes really sense. This according to a New York Fed survey that recently came out, as respondents are indicating the ability to get loans, credit cards, and mortgages is now harder than it was a year ago, nearly rose 60%, the highest level in the data series that goes back to June of 2013. Now, this is really interesting because consumers are already on this pulse of difficult ability to get credit before anyone else. And why would they need it? Because they couldn't afford higher prices. We made the case and show the other day that total income, total compensation was lagging inflation. And what do consumers need to stay ahead of it? They need access to credit. What did they find? It just wasn't there. They're draining down their savings, draining down the pandemic stimulus, and at some point, it all comes to an end. And fears of credit access have been rising steadily since early 2022, around the same time the Fed began raising interest rates. And since March of last year, the central bank has hiked key borrowing rate a whopping 11 times, totaling 5.25 percentage points as it seeks to tame inflation. In reality, as it seeks to drive us into a financial crisis. And yet consumers figure this out when the Fed starts raising rates. Normally, it actually takes a while before the banks start tightening lending standards. As you can see here back in 1998, Fed had raised rates quite a bit. Here you can see going into the global financial crisis, the Fed actually had raised rates and plateaued before the banks started tightening lending standards. The same thing going into the pandemic. This time, investors said, no, what your consumers said, you know what? We don't buy it. We're not getting credit at all here. And that's because how quick the yield curve inverted. And this is a big problem for American consumers, will be a huge problem as well for those small businesses who find out that demand is going to dry up. They're going to need credit to stay afloat, and the banks aren't going to be there for them, maybe at all. As worries are rising about employment, the survey showed that the mean expectation of losing one's job in early next year rose by 2 percentage points to 13.8%. That comes with an unemployment rate of just 3.8%. Of course, what we've noted that as financial conditions tighten, as of course there's less money created because there's less loan growth, eventually it starts to come back to higher unemployment claims. What we're hearing from these small businesses, hey, they're willing to hang on for a while. The question we continue to ask is for how much longer, because I don't think they've got a lot of runway left. And yet central banks are set for higher for longer to fight inflation, which is baffling because next Wednesday the Fed will take center stage as they normally do. Officials are turning more optimistic that they can quash inflation without causing serious economic pain, a fantasy only that a central banker can have. And meanwhile, bond markets give almost no chance of a rate hike at the upcoming meeting, and economists are in agreement rates will be steady following the clear signals, which we've never get, by the Fed leaders that they plan to pause any hikes this month. But one thing we do think is going to go a whole lot higher is not the federal funds rate, but the stock of our sponsor today, and that is Metre. They're an innovative solutions for the prevention and management of chronic disease, leading to the enhanced health and well-being. What they're focused on is digital solutions for weight loss and the potential reversal of type 2 diabetes and pre-diabetes. You can find them on the NASDAQ under the symbol NMRD. They just had an interesting press release. We'll take a look at that, and I want to go through the chart setup of why I think their stock could move 40% higher off this base here with the potential to even double in value. And they just announced yesterday that Metre completes a 100-patient study for their sugar beet 24-hour wear and reports interim results. You might remember we covered them early last month, and what they said is their product is a non-invasive wearable sensors and supports personalized diabetes management and metabolic health programs. Today it announced it recently completed its study, and wow, they've got some good results, and it indicates that the 24-hour sensor wear period using a single sensor, which in the past was not possible, is now indeed possible. It's expected to allow users to monitor their glucose fluctuations overnight, and they're further evaluating the remaining cohorts and variables with a view to establishing the extent to which auto-calibration may now also be feasible, and also determine the optimal sensor application method. And we look forward for more information coming from them in the future about their technology. But let's take a look at what I think for their stock, why I say the opportunity opportunity is now. Now, what happened here back in August is there was a bunch of selling, probably from large investors. We don't have information on who they were, but we can look at the volume and say, look, somebody, for whatever reason, was exiting here, and this created a potential big opportunity. As you can see now, we established a whole new supply zone down here in between these orange lines where buyers stepped in. It rallied above up into the sell zone. There's further selling by whomever, and now you see the price of the stock came back down into the supply zone on the RSI, massively oversold. Look at the MACD, it's starting to bottom and roll higher, and what we're making the case around 40, just under 40 cents as the time of recording, a move up into the 55 or 58 cent range. There's your 40% move. If these sellers are cleared out, which we will find out at some point, well, then you're looking at the stock moving all the way back up to around 80 cents a level. There's your 100% move. As we zoom in, we can see the supply zones very clearly here, and we can also note the RSI is coming off that oversold territory. It's slowly, momentum is moving higher. The MACD is flatlining, but look at this. You see price come down right in the supply zone. Buyers step in there, not a problem. It rallies up. Those sellers continue to clear out their inventory back down here into the supply zone, and sure enough, buyers step in. And what we want to show you here is if you're going to put a trade on this, you want to put your stop loss probably somewhere a little under 36 cents, maybe around 35, 34, 33, wherever you're comfortable with, and you're going to look for an initial move up into this 55 to 60 cent range. Maybe that is where you're happy with. What you could do is raise your stop loss level up to that point, or even maybe put it somewhere just over the 50 cent range, throw on a trailing stop, and look and see if the thing makes a move up to that 80 cent level. Here you can see momentum on the RSI continuing to rise. But as always, with any stock or any company we feature on this show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.